What's up, apes? Welcome back to the 𝗪𝗚𝗄𝗃 daily podcast / video of the day. Thank you all for tuning in once again on this beautiful Thursday, August 8th, 2024. It is currently 8:23 p.m. here at the 𝗪𝗚𝗄𝗃's global headquarters. We got a lot to talk about here today. We're going to be talking about some good news for the housing market for the first time ever. Basically, my takeaway is that the housing market and Freddie Mac specifically had to just wait until I signed the dotted lines before they could actually bring rates down. But we'll get into exactly what's going on in just a quick second. We had an absolutely disgusting earnings day from the likes of Bumble. Love is in the air, but they're having a tougher time monetizing our sex lives, apparently. And then we saw a very good day from Under Armour, despite horrific performance from Nike in their latest quarter. Now, Nike's not going to report till towards the end of September, so we don't really have too much of a light comparison because Nike's last report was for the first quarter, and the timelines are just a little bit off. But still, horrible day for Nike, great day for Under Armour in response to their latest earnings. And then we're going to be talking about population dynamics here in the United States, which states are stealing all the people, which states are kicking them out, and where you should move to if you want to be standing next to the biggest pile of cash possible and earning as much as you possibly can. Of course, thank you all for tuning in once again. If you like the quote-unquote content, if you can even call it that we're putting out here at the 𝗪𝗚𝗄𝗃, make sure to give us a like, a subscribe, refer to your friends to the 𝗪𝗚𝗄𝗃. Really do anything to grow our subscribers, our views, boost our algorithm as I humiliate and essentially flashlight myself here on camera and beg for your approval. It'll probably help me keep my job for a little bit longer, but what will probably help me keep my job is if I actually talk about what I'm supposed to talk about here instead of just yapping for hours at a time. So let's go ahead and get into that. First of all, phenomenal day for the markets. Round of applause. A round of applause for the S&P 500, the NASDAQ, and the Russell 2000. Each one of those indices was up at least 2% for the session, with the S&P bringing up the rear, up 2.3%, followed by the Russell 2000 up 2.43%, and the NASDAQ up 2.87%. Huge up day for large cap tech stocks. We saw NVIDIA up 6.13% for really no reason whatsoever. We also saw a very good day pretty much across the board. Specifically, another company had a great day called Zillow Group. This was our first equity research report that we published for the WSO Alpha portfolio. It was easily our leader for the session, and despite the fact that shares rose 18.22% today, the WSO Alpha portfolio did lag behind slightly, up 2.19%. We have a little bit less exposure to, mega cap tech than the indices do, so that's why we'll trail behind on updates that are led by mega cap tech stocks. But nonetheless, when the market regains its sanity and realizes there's more than 7 companies to invest in, we plan to be on top. That's exactly why we've outperformed, since inception for the last 10 years, for the last 5 years, and for the last 3 years. It's really just over the past 7 months or so that we've been relatively down bad. In fact, haven't even been down bad, but just compared to the indices, we're up 6.07% for the year so far. Not too bad, but still embarrassing the fact that we're underperforming the indexes. We'll see if I have to fire any analysts this month. Let's go ahead and get into some of the banana bits for the day today. So first and foremost, we got some good news on the jobs front as well, which is really the reason that the market outperformed so much, because last Monday's complete meltdown, I know a lot of people are citing a Japanese carry trade as the fundamental driver of it. Yes, that probably had some of an impact, but really what I think happened on Monday was more of an amalgamation of a bad jobs report, a relatively bad earnings season, and basically just a worsening economy. Again, not bad, but worsening. Just not in the Goldilocks period anymore. All of the effects from COVID are basically gone, and with those effects gone, we're back to normal economic circumstances. We don't have too much of a demand boost or too much of an artificial boost from the Federal Reserve and the federal government sponsoring demand on behalf of these companies. So it was really all of that just coming together at once. But let me go ahead and actually talk about the report that I started to. So jobless claims last week, they dropped by the furthest amount in more than a year last week. We did see it was at like 233,000. It was expected to be like 248. So it was just the fact that it outperformed a little bit that gave us confidence that the economy isn't completely falling apart. And that's really all the market needed to have a one hell of an up day. Okay, meanwhile, Elon Musk's X versus everybody lawsuit. I believe that's the technical title of it, but this is the lawsuit where X, formerly Twitter, is suing every advertiser on planet Earth just about for boycotting advertising on X. It's already causing some changes. I kind of thought this would be a frivolous lawsuit because I'm not a fucking lawyer and have no idea what I'm talking about, but it's already causing changes. The global advertising market, they are effectively shutting down like a safety team that they have with them. Again, I'm not a fucking lawyer. Just click on the CNBC article right there and you'll have the same understanding that I do. Meanwhile, TKO Group. This is the owner of the UFC, of WWE, and the owner of the company that I lose money on just about every single weekend with all these bets that I'm throwing. They just hit an all-time high yesterday, probably for stealing all my money on those bets. But nonetheless, they had a great second quarter report. Stocks hit an all-time high. Great day for Dana White and Vince McMahon. Meanwhile, the percentage of homes listed that have experienced a price cut jumps to an all-time high at 7.2%. We're going to talk more about housing in just a second. And finally, the first Trump-Harris debate has finally been scheduled. Where do I bet on the odds of a civil war? Does anybody know where I can do so? Either way, I just really hope the debate happens, provided neither one of them falls out of the coconut tree before the debate actually begins or gets shot. I mean, that would be ideal too if neither one of them can do that. But we'll ultimately see. It should be in the beginning of September. I believe September 10th is the date that has been floated. Okay, let's go ahead and talk about our macro monkey major story of the day. We were talking about interest rising as rates fall. I know, sounds absolutely insane, right? Probably because it doesn't make any sense, and neither does anything in the US housing market. All I know is that today Google searches for how to refinance my home are rising more than Nvidia stock after this dive in mortgage rates that we saw today. Now, let's go ahead and take a look at it on the chart. Bang, bang. You can't see this at all, but trust me, it is going down. This is a 5-year chart, so it's a relatively unnoticeable drop anyway, but you can see it if you look all the way back here for August 2024. 30-year mortgage rates have fallen to 6.47%, with a 15-year fixed rate mortgage down to 5.63%, both the lowest that we've seen since May 2023, aka in the past 15 months. So an absolutely phenomenal time to be getting into the mortgage market. Now, Freddie Mac, obviously, they heard that I had just signed the dotted lines and they figured it was time to lower mortgage rates. So I'm going to be officially starting an OnlyFans account. I think it's really the only side hustle that I can think of. So please go subscribe. I think the name I'm floating with is going to be the Daily Revealed. But if you have any better ideas, please feel free to leave them down in the comments and I'll humiliate myself even more than already. But either way, a great day for the housing market nonetheless. Like I said, falling mortgage rates, that's something that we can all get behind. It benefits home buyers, it benefits home sellers in this market. It's just a great thing for pretty much everybody. Now, if this decline holds up and it's really not just Freddie Mac giving me the finger and telling me that I timed the housing market wrong, then this could be very beneficial not only to the housing market, but to the economy overall. If we look back, what's happened over really since like late 2021 in the post-COVID period, buyers have been priced out of the market by a double whammy. Both high interest rates as well as high home prices have effectively kept a ton of buyers priced out of the market. Meanwhile, would-be home sellers have been effectively trapped in their houses as if they were Jeffrey Dahmer's next victims because they didn't want to move or they were hesitating to move into a new location and effectively double their monthly payment to afford to live. So it's really been bad for both sides of the market. So again, much like how the economy is worsening but isn't bad, the housing market isn't good, but it is bettering or getting better, if to use proper English. Now, it's no surprise that 2023 saw the lowest number of home sales since before 𝗪𝗀 Lewinsky was even a household name, way back in 1995. That is when we saw the lowest, that was the last time we saw home sales lower than in 2023 at 4.09 million. So we can't really be too surprised that 2023 was such a bad year given that dynamic that I just explained about buyers and sellers. But in 2024, it is starting to get a little bit better because mortgage rates are declining. And just as time goes on, eventually desperation is going to add up and people are going to say, we just got to get the hell out of here. So we're starting to see a whole lot more listings. And that is exactly what you're seeing in this chart right here. Right now, you see, again, you can't see it on this chart at all, but there is a little bit of an uptick in both existing home listings that you see in this kind of like faded bluish color, and then this green line is new home listings. Now, the new home listings especially have been absolutely cooking in recent months. Home builders are actually doing their job once again. And if we look at supply on a monthly basis, what I can see here, what you probably can't see, is that the month supply of new homes is nearing not record highs for new homes at the very least, but close to relative highs. Like it's very high compared to historical rates. So what we're seeing right now is more than 9 months worth of supply of new homes existing on the market and approximately just a little bit over 4 months of supply for existing homes. Now, effectively what this is calculating is the number of months that the current supply of housing could support if current rates for the most recent month that they crunch the numbers continued. So basically, how many months would it take to sell through every single new house in the United States if not another one was to be built? And that's exactly what we're seeing in this chart. It's a little bit over 9 and a little bit over 4 on the existing homes side. Now, if you're thinking what I know that you very wise apes are thinking is probably that, okay, there's still, there's relatively high demand to get into the mortgage market. there is an explosion of listings on the market right now. Obviously, prices are going to go down. Well, I hate to tell you this, but the market doesn't give a fuck about what makes sense, unfortunately. But so what we're seeing right here is the median sale price of all homes in the United States, both new and existing. What we're seeing is that we're still at all-time highs. Now, this data is from June because it takes, calculating any data in the housing market is slower than fucking Congress. So, bear with me while we can. We're at $442,000 is the median sale price in the United States per the Redfin Home Price Index, which is the one that I trust more than S&P Case-Shiller, more than the Fed, more than all these other bullshitty ones. This is the one that I trust because it's done on real market data on the Redfin platform. Now, it does so happen that Redfin is they're kind of on the short side of our spread trade for the housing market here. We do own Zillow, as I referenced before. The stock was up a shit ton today because they just reported earnings, and who knew? They're absolutely killing it with all this high demand. They saw 42% growth in their mortgage origination revenue, just like we projected in our analysis. So make sure to go ahead and subscribe to WSO Alpha as well. That is my shameless plug. But before I go on to the big stock movers, I want to reiterate 3 big takeaways from the housing market today. First and foremost, with mortgage rates falling to 15-month lows and listings continue to rise, housing market activity will increase in the coming months. But affordability is going to remain a challenge at the same time. As we can see right here, demand remains so elevated primarily from boomers moving into their retirement homes, as well as millennials and Gen Z, bringing some of that pent-up demand to buy their first home. So it's kind of a triple whammy from all of these different generations. And if this increased activity holds up, this is a great sign for the U.S. economy because housing is the largest asset class in America and homes are the largest assets for most Americans. So if home prices increase, that brings a wealth effect. It also means that not the home prices, but if mortgage rates decline, that means that consumers are going to be able to refinance and afford to spend more of their money donating to the economy outside of the housing market. So a great thing all around. Love to see that the market's up on the day, and it really gives you that American pride that we so desperately need at this time. Let's go ahead and move into those stock movers of the day. For our first What's Right name, we have Under Armour. Under Armour up 18.3% for the session. This company clearly is defecting to the British because I just found this out today, but they actually spell their name, the armor part, ARMOUR. I don't know how I didn't notice this for 24 years of life, but nonetheless, they're clearly defecting to the British, but it kind of makes sense that they're defecting to the British because analysts had the exact same reaction to the company's earnings report that most people have when they go to London, in that it was much better than feared, or at least a little bit better than it was feared. So in that sense, I guess maybe they deserve the British spelling that they always go with. But nonetheless, the company reported a surprise profit of 1 cent per share. Doesn't sound like a whole lot, but expectations were for a loss of 8 cents per share because Under Armour is currently going through a huge corporate restructuring. They're trying to regain relevance to get up to the level of their older brother, Nike. I don't know if that's the best strategy, considering that Nike basically committed seppuku after its last earnings report and just completely fell off a cliff. But nonetheless, Under Armour is here to try to eat their lunch. Sales were down 10% for the year, but still managed to beat expectations. Okay, let's go ahead and move on into the largest healthcare company in the world, in Eli Lilly. The stock was up 9.5% for the session. Is this thing at $1 trillion market cap now, by the way? I really think it's got to be close, I think. No, it's only at 803 billion. Sorry, just a measly little 803 billion. That's what we make on our sleep here at the Daily Peel. But Eli Lilly stock was up 9.5% for the session. The company's weight loss drugs are powering fat growth on the bottom line for this company. Zepbound and Mounjaro are Eli Lilly's 2 weight loss drugs. Mounjaro is a diabetes drug, and Zepbound is specific for weight loss, and it is an injection, apparently, I'm pretty sure. But nonetheless, basically, the reason that they outperformed so much, or that they were able to raise guidance by so much, and specifically by about 6.7%, is because Novo Nordisk was on the opposite side of this trade. Novo Nordisk, this is I think it's Dutch, but it might be Danish. I'm pretty sure it's Dutch. I think they're based in Amsterdam. I'll have to double check on that. But either way, Novo Nordisk came out earlier this week with their own earnings, and it turns out that Wegovy sales were slumping because the company just simply doesn't have the production capabilities to meet U.S. demand. So Eli Lilly stepped in with Zepbound and Mounjaro and absolutely ate their lunch. Okay, let's go ahead and move on into the What's Rotten names. Bumble down 29.2% on the session. That reminded me way too much of when I used to open the app and see my likes had performed roughly the same. I actually had negative likes. Now they sent me an email that I was the first person in history to do that. But nonetheless, the stock followed suit yesterday, down 29.2%. It's getting a little bit more difficult to monetize love and most of all monetize the sex lives of college students across America, as the company saw revenue grow about 3% to $286.6 million, still missing estimates by 1.6%. But much like users' photos, earnings were looking a whole lot hotter than they actually may have been. They beat as net margins more than tripled themselves from 3.6% in the same quarter a year ago to 14% in the current quarter. Now, the problem and the reason that they weren't able to monetize as well, or the reason that we can say that they weren't able to monetize as well, is because the company did fine in terms of growing users. Paid users on the Bumble app grew by 15%, but ARPU at the same time fell by 8.6%. So that was really where the decline came in. Less people are, I guess, paying up for those like micro purchases or maybe the major premium services or maybe the combination of the two. They're paying the basic subscriptions but not paying for any of the, additional features that you get along the way, I suppose. Either way, like I said, it down 29.2% for the session. Finally, we have Warner Bros. Discovery. This made me so fucking happy to see because I can't stand David Zaslav, the ultimate dick rider and brand killer in HBO, and just literally has never done anything in his career besides be at the right place at the right time. And it's easy for me to heckle from the cheap seats, but it's even easier when the company loses more in the quarter than they earned in revenue. That is exactly what happened to Warner Bros. Discovery. The company registered revenue of $9.7 billion in the second quarter, but they lost $10 billion even. $10 billion loss for the quarter. Absolutely fucking disgusting. Borderline negligent, probably criminal, should be arrested by CFS for all the shareholder savings that they wiped away and the effects that that's going to have on the children of these shareholders. Just a completely disgusting performance for the last quarter. Sales were down 6% year over year. Free cash flow tanked 43%. And most of the reason for this loss was due to an asset-based write-down. So there was a $9.1 billion write-down in the company's linear networks, and they also lost an additional like $300 million on asset sales. So in total, it was like a $9.43 billion write-down, but $9.1 billion of that came from a network impairment charge. Now, they kind of tried to bullshit this away a little bit, but effectively, what happened was the company's odds of renewing its rights to NBA games are extremely low. We talked about this recently, how the NBA is basically in a throuple with Amazon and one other streaming service. I forget exactly, probably Disney, but either way, the NBA is not coming back to Warner Bros. Discovery, at least on its network side of the business. Now, it could certainly be in the HBO side of the business, but that's not where the assets were valued $9.1 billion higher at the end of last quarter. But that's what happened this quarter, and that's what led to that $10 billion loss. Making it even better, CEO David Zaslav said that he is extremely pleased with the Q2 results. We got to get this guy drug tested. We got to send him to a mental institution. I hope his family is there to help him through this clearly psychotic break, but nonetheless, that's what happened with Warner Bros. Discovery. Finally, this is going to be a real quick one for our Thought Bananas, but I wanted to talk about a State of the Movers address. Not State of the Union, yet at least, until you guys all start voting for me, but we have State of the Movers. Now, it's a difficult decision when you're deciding where you want to live in the United States. For most people, you're born, you grow up in a certain area, and then you have to decide, do I want to be absolutely fucking miserable and stay near my family, or do I want to go have an enjoyable life? Now, that question varies for everybody depending on their loyalty, I guess, to their family, but what we're seeing right here is that people are very much so taking up the option to live in a place where they won't need a Prozac subscription to get through the day. Let's go ahead and see exactly what I'm talking about. This chart might look a little bit familiar to a lot of you guys because this was linked in our Banana Bits yesterday, but it's showing the states that people are moving out of and moving into. The bluer the state that you see right here, the higher rate that people are moving out of it. The more orangey kind of Florida, Texas color, the faster people are moving into that. And again, this is on a per capita, kind of a relative basis, not absolute, because obviously California is going to have more people moving out and moving in than something like Wyoming, but still, that's what the chart is encapsulating right here. What do we notice from this? It is the exact same trend that began during the pandemic. This trend was not in place before the pandemic had started, or at least not to the same degree. So what this is effectively telling us is that there's some effects from the pandemic that are here that are longer lasting, and that includes a demographic shift across the United States. And there are some that are not here, not longer lasting, like wearing masks to when they said we weren't going to fucking shake hands anymore. How stupid was that? I almost just said an R word right there, but I'm glad that I caught myself so that we don't get demonetized or canceled on YouTube here. But nonetheless, there are certain trends that are gone with the wind from the COVID pandemic, but this is absolutely one that is here to stay. I'm going to show you another chart, and you're probably going to have a tough time believing that this is a different chart, but in fact it is. This is a chart from Redfin. I think they copied the exact color schematics from the Census Bureau, but nonetheless, it's showing the exact same thing. So Redfin, the reason that I'm showing you Redfin data is because this chart shows you the information between the years of 2020 and 2023. This is showing you that same information between March 24, 2024 and the end of June 2024. So really, effectively the second quarter of 2024, we're seeing the exact same trends. We're seeing California, New York, Massachusetts, Washington leading the way in terms of a quick geography lesson for you non-American visitors, by the way, viewers, not visitors. You should visit though. But nonetheless, this is exactly what we're seeing, and they don't have data on Wyoming or North Dakota. So that's effectively what we're seeing right here. But what was even more interesting was to drill down and take a look at the cities that people are moving into and out of. And the particular interesting aspect of it was because even though California looks like this, and it seems like everybody is flooding out as fast as they possibly can, California led in both the number one, California led in having the city that was the number one most moved to state in the second quarter, as well as the most moved from state in the second quarter. So to go through the one that people moved to at the fastest rate, number one was Sacramento, California. Number two was Sarasota, Florida. Number three is Phoenix, Arizona. Number four is Cape Coral, Florida. And number five is Myrtle Beach, South Carolina. That's basically right down the street from me here in Charlotte. Meanwhile, the top five most moved from cities were Los Angeles, California, New York, New York, San Francisco, California, Seattle, Washington, Washington, D.C., and number 6 was Chicago. And I threw that 6th one in because I just happened to remember it. Boston was number 8th as well, the hometown. Shout out to Boston and Titletown. So really, it's not a huge takeaway here, just talking about some of the lasting effects of COVID versus some of the more temporary ones. And this is clearly going to be one of those lasting effects. It's not necessarily about seeking warmth and sunshine, however, because as we can see, one of the fastest moving states is Maine, another fast one is Michigan, and Idaho are all very quick. And I don't think those are states that you would exactly call warm. Definitely not people from the Sun Belt region down here, and that's exactly what we're seeing in this kind of Midwestern corn-growing states. People are dipping out of there. So it's not all about warmth. It's really more of a question of space, if you ask me. And that's why you see states like Texas, even though, Texas is the second most populated state in the United States, has the 4th most populated city in Houston and 6th in Dallas-Fort Worth. But still, people are moving into Texas at record rates. It's enormous. They have the space. They can build out there. Compared to the house that I bought in Massachusetts, if I was at the same price range and buying in Texas, we would have a literal fucking mansion. But in Massachusetts, it's effectively a shack until I get in there with my bare hands and, clean it up just a little bit, as we always do. All right. Demographics are destiny. That's also the last thing that I want to leave us with. Now, this matters more to national level for us in the United States, but still, if your population is declining, it's very difficult to grow an economy. Now, again, that's more relevant at a national level than a state level, but still something to keep in the back of your mind if you're one of these very blue states. All right, and that about does it for us here, but let's go ahead and leave you with a quote for the day if I did put one in here. Oh, I did! From our boy, Mr. Scott Galloway, the professional yapper on way too many podcasts, and also a professor at NYU, but he's a damn good writer. Go subscribe to No Mercy, No Malice, and as well as go read The Four. That's a great book. I haven't read any of his other books. Actually, wait a minute. I think I have one of his other books here with me. It's that chart, that picture book, but that's a great one too. But nonetheless, he once said, stand next to the smartest person in the room and try to be helpful. Or stand as close as possible to the biggest pile of money and try to be helpful. I think I know which one we're all going to be trying to be close to. No, absolutely for me, it's going to be the latter right there. And I certainly hope that Patrick lets me get nice and close to that bag. Nonetheless, apes, that about does it for us here today. We're at about a minute shorter than the day prior, and I do apologize that I cannot stop yapping on these calls, but, if you got any notes for me, definitely let us know down in the comments below. And that about does it for today. It's 8:46 p.m. Happy investing, happy trading. Bye now.